The three best performing sectors in an otherwise good month of May are technology, what else, but utilities and staples as well. What does that sort of odd mix say about the market and the economy? Welcome to Trading Nation. Max Wolff with 55 Institutional, R.A. Wald with Oppenheimer. Max, first to you. Tech we get, right? There's all these crazy stats. I posted some on my Facebook page, facebook.com/SullyCNBC. But what do you make about the fact that utilities are also in that mix? Sort of an odd combo.
Yeah, it looked to us like a tug of war, right? So you either totally believe and you think growth is coming and you want to get the high multiple, high risk, high return growth names, or you're really nervous, you think you're way out over your skis and you want to hunker down and have consumer non-discretionaries and utilities. It really speaks to a market where half the people are pushing one way and half the people pushing the other.
Yeah, well, which way would you push? You think tech's overdone or utilities are still a good bet, Max?
So I also think some folks might put them together. So I think tech is really overpriced, but at least it delivers growth, and that's why people are crowding in there. And it's also a place in the United States that's sort of globally peerless. And then on utilities and defensives, I mean, I understand that too, because things have gone on longer than they should have, and there's a lot to be nervous about. So actually, if you could ride that dissonance, it kind of makes sense as a portfolio. More broadly, I think some people just believe that software is going to eat the world, in the words of Mark Andreessen, and some people feel like the world's getting eaten and not by software, and they're hunkering down to utilities and defensives.
All right, Ari, what do you make of this from a chart perspective, this sort of odd conglomeration of sectors that are doing well?
Yeah, I think there's some different themes going on here. I mean, for the most part, these market rotations that we've been seeing, not only this year, but for the past several years, one of the key factors has been interest rates. And I think more recently, with interest rates turning lower, you've seen these the sectors that act as bond proxies, like utilities, and consumer staples as well, become leadership, while the flip side of that trade, financials, have really been under pressure. We think that is a trading call. We think interest rates more or less are going to remain range bound. I think there's going to be a point where you see rates flip higher again come second half of the year. But throughout these market rotations, whether it's risk on, risk off, rates up, rates down, commodities up, commodities down, technology has really been the resilient sector that's been able to outperform through all those market environments, and that really fits the general theme that we've been recommending, is to buy cyclical growth that gets you exposure to a rising equity cycle. We think the equity cycle is still higher, but a group that's also going to be less influenced by what we think is going to continue to be this range-bound and oscillating interest rate market. And in the chart I brought is Russell growth, tech heavy versus the Russell value, and you can see Russell growth breaking out to the upside. This is the theme we think long-term investors should be keen on.
Okay, we're watching it. We're watching interest rates as well as stocks. That's great advice as always, Max and Ari. Thank you both very much. Folks, thank you for watching Trading Nation. I'm Brian Sullivan. We'll catch you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.